Alright, hi, my name is Russell Pellequino, and this is my comparative industry analysis on 3 different industries. It's going to begin with the gaming industry, we're going to move into merchants, and then lastly we're going to do motors. On this screen is going to be my PowerPoint. On this screen is basically a spreadsheet of the ratios that I use as research. They're color coordinated so you can follow, and then the yellow is going to be the highest per year per industry. So, as I said, I'm going to start with gaming. As you look at the current ratio, Pinnacle is clearly the most liquid by a pretty large margin. Then, as we move into quick and cash, we see MGM steps up a little bit above them, which likely means that Pinnacle has a lot of inventory, but they're also in a pretty decent position compared to the others in terms of quick and cash, but MGM has the most cash on hand. Then as we move to leverage ratios, we see that Pinnacle is pretty highly leveraged by debt, far more than the rest. MGM stands in a pretty good position in terms of debt and equity, both. They have a very low percentage, and it's pretty well balanced between the two. Whereas Pinnacle is probably the most highly leveraged, and Isle is close behind. Then as we move down into the cash coverage ratio, we see that Penn is the most highly, is in the best position in terms of their ability to cover their debt. MGM is also in a fairly good position, and Isle as well. So next we're going to move into asset efficiency. As we look at asset turnover ratio, we see that Penn is in the best position and has been close to the top, if not at the top, in the past 5 years in terms of asset efficiency. One thing I did like is that MGM has made consistent strides. Although they are the lowest, they have consistently increased in terms of asset efficiency over the past 5 years, which is a good sign for the future and for potential investors. So next we're going to move into profitability. In terms of profit margin, MGM is in the best position. In the past year, these have all the different businesses that I went through in this industry have pretty inconsistent numbers in terms of profit margin, jumping from very low negatives to very high positives and whatnot. So there's not a lot to get from that. But as we move into ROA and ROE, we see that MGM has earned the highest return on assets and return on equity 3 of the past 5 years. Which is a very good sign in terms of efficiency and returns for MGM. I like Boyd. They've made some consistent movements, some consistent increases, but in small margins. MGM really takes the lead stance in terms of profitability. So next we're going to move into ROE breakdown. Just to see what is driving the numbers. In terms of interest burden and tax burden, pretty inconsistent numbers. Not a whole lot to really give us any definitive information. But when we look at operating margin, we see that MGM has had pretty substantial increases over the past 3 years. Also, Pinnacle has done a very good job increasing their operating margin. So that's likely what is driving their increased returns. Lastly, we're going to move into market value and EVA. In terms of PE ratio, we've seen a lot of the firms that I covered, they had negatives, but the ones that they did post are all pretty good, which this shows, where they stand in terms of stakeholders investing and what stakeholders see in future growth for the firms. From that, we see that Pinnacle and MGM, again, are at the top. MGM specifically has the highest in terms of PE ratio. Looking at the market to book, MGM is pretty consistent and pretty consistently increasing over the past 4 years, which is a good sign of what they're getting with their out of stakeholder money. Also Pinnacle, pretty good position, but I like MGM's steady increase again. So now as we move down to EVA and competitors, we see that MGM is clearly the highest by a very substantial amount in terms of economic value added, as well as their return on investment capital. They also have the highest market cap, and they have the highest earnings per share. This is a very good sign for investors, and it's also a good sign for shareholders. You know, they're making shareholders money, and they're keeping them happy, which is why my choice is MGM from the gaming industry. I like the fact that they're showing improvements, although small. They're showing consistent improvements to asset efficiency. They're the least leveraged with the best balance combination of equity and debt, and they're taking less risk. Basically, they're taking less risk and earning higher returns. They're maximizing shareholder wealth, and they're adding substantial value to the company, which is why they're my choice in the gaming industry. So, next we're going to move back to liquidity, except now we're going to go on to merchants. In terms of liquidity for merchants, we look at the current ratios, and we see that Fred's has the highest all 5 years by a pretty large percentage, but relative to the other companies, this may not be necessarily a good thing. It may show a bit of an inefficiency in assets, in use of assets. So then we move down to Quicken Cash, which is where we see the Dollar Tree is the highest in both categories all 5 years by a pretty good bit, but it's not high enough to where I would think that there would be any inefficiencies. They stay right around 1 or 0.5, which is a really good sign for Dollar Tree. We also see some consistent increases from Family Dollar and Dollar General over the past years, which I like. So now we're going to move into leverage. In terms of debt and equity, Family Dollar is the most highly leveraged by both debt and equity. Although they're highest, they're not very high. They're not highly leveraged. They're just the highest relative to the other 5 companies. Dollar General is close behind, as well as Dollar Tree, but all 5 companies, especially Dollar Tree, Family Dollar, and Dollar General, are in pretty good positions in terms of balance between debt and equity. Then we move to cash coverage. We see Big Lots in last year's numbers was the highest. Fred's has been close behind, with putting up pretty high numbers in this category, as well as Dollar General and Family Dollar have put up pretty high numbers. This shows that they can all easily cover their debt, which is also a good sign, and puts them in a very good position for the future. So next, we're going to move into asset efficiency. In terms of asset management, Big Lots is the highest for the past 3 years running. Dollar Tree close behind, and I also like Dollar General because they are showing small increases, not necessarily the highest, in fact the lowest. But again, I like this consistent increases, consistent improvements in terms of future investors and in the future of their company. So now we move to profitability. In terms of profit margin, we see that Dollar Tree has earned the highest profit margin by a pretty large number. Dollar General is relatively close behind, and Family Dollar behind that. But over the past 5 years, on average, Dollar Tree has come out pretty far ahead of the rest. Then we move to ROA and ROE. In terms of both, Dollar Tree is at the top spot. They've earned the highest return on assets all 5 years. They've earned the highest return on equity the past 2. And although they are at the top, Family Dollar and Dollar General again are putting up pretty high numbers. More so in terms of ROE. In terms of ROA, Dollar Tree is pretty far ahead by a pretty substantial margin. ROE, all 5 companies seem to be putting up pretty solid numbers, which is a very good thing. Then we move to just ROE breakdown, trying to see what's driving the numbers. In terms of tax burden, interest burden, we don't see any substantial increases or decreases, anything that would be driving returns or anything like that. But moving on to operating margin, we see that Dollar Tree and Dollar General are pretty far ahead of the other 3. Dollar Tree's the highest, but Dollar General's close behind. This is likely what's driving their high returns. So next, we're going to move to market value and EVA. As we look at the PE ratios for the 5 companies, Fred's is the highest in the past year. Family Dollar the year behind, Dollar Tree the year behind. So in terms of leaders, there's nothing you can really see, but when you look at the numbers, Dollar Tree has consistently put up high numbers, above 15 over the past 4 years, and as well as the other companies. They all are in a pretty good position in terms of the PE ratios, which shows that they do have future growth in the eyes of stakeholders. A lot of investors and shareholders don't mind investing their money in them. They see future potential. As we move to market to book, we see that Dollar Tree is pretty far ahead of all the others. That means that essentially they are making more money off of shareholder money, which is always a good sign for shareholders and potential investors. So next we're going to move down to EVA and competitors. In terms of EVA, Dollar General has the highest at 561. Dollar Tree is next at 412, and those numbers are in the billions. The millions. But I like Dollar Tree because they have a return on investment capital of more than double Dollar General's. Also, EPS, we look at, and Dollar General has the highest earnings per share, and as well as market cap, which shows that they're making money for their shareholders, which is always a good thing. So this leads me to my choice, which is Dollar Tree for this industry. As I spoke of earlier, they're very well balanced between debt and equity, as well as some of the other firms. But I like theirs because they're making the highest returns. They're also having consistent improvements in terms of asset efficiency across all 5 years, which is a good sign for the future. And they're adding significant value to the company. And I see a lot of growth potential with them. And I like what they're doing across the board in terms of strategy and performance. So next, we're going to move to liquidity and leverage for the motors industry. As we look at current ratios, we see that Chevron has performed the highest, and for the past 5 total is at the top for the last year. But they all stand at a pretty good position in terms of current ratio, and but then as we look into quick and cash ratio, we see that Chevron led all 5 years in both categories, which clearly states that they're the most liquid. They have the most cash on hand, which is always a good thing. and the fact that it's not far beyond that of their competitors, so it's not inefficient. It's relatively close, but it's at a good percentage. So next we're going to look at debt and equity. BP is the most highly leveraged by both debt and equity over the past 5 years. This is likely due to the recent oil spill, and the lawsuits and everything else that came from it. But I also like Exxon, and I also like Chevron in both of these categories. They have very little leverage. It's been increasing by small percentages over the past 5 years, but relative to the other companies and whatnot, it's at a good percentage. It's well balanced, and also as we move to cash coverage, we see that Exxon has the highest, and by a very large margin, which shows their ability to cover this debt. Chevron as well is putting up substantially high numbers, and BP is putting up good numbers too. So although they are the most leveraged, all these companies are in an extremely good position in terms of being able to cover their debt. So next, we're going to move into asset efficiency. As we look at the asset turnover, BP is at the highest for the past 3 years, and they're at the top of the board for the 2 years prior as well. This is a good thing for investors to see, but I don't like that it has been decreasing across the past 4 years. Exxon also has been decreasing, but are putting up fairly high numbers. And Total is close behind, putting up pretty good numbers, and they're increasing over the past 3 years, which is a good sign. In terms of profitability, we look at profit margin first, which we see Conoco has the highest profit margin across 4 of the past 5 years. Exxon pretty close, relatively close behind, as well as Chevron. All of them seem to be putting up pretty high numbers in this category. Moving to ROA and ROE, we see that Dollar Tree has performed exceedingly well. In terms of ROA, they've come out on top 5 of the past 5 years. And in terms of ROE, the past 2 years they've come out ahead. And in the 3 years prior, they were just behind Family Dollar. This is a very good thing in terms of efficiency and or returns on assets and returns on equity. But in reality, all these companies are doing pretty well, with the exception of Fred's, who seems to be trailing pretty far behind. So as we look into ROE breakdown, we see that the operating margin of Conoco is the highest, but Exxon, Chevron, and Total are also putting up pretty high numbers, which is likely driving their high returns. So lastly, we're going to move into market value and EVA. In terms of PE ratio and market to book, we see that BP put up the highest PE ratio the last year, Exxon the year before, and then BP the year before. Really though, all 5 firms have very well kept up their PE ratio, as well as their market to book. Market to book, Exxon takes the lead spot by a pretty good number, but all 5 companies are in a pretty good position, which means essentially that they're all making good money on shareholder money, and they see shareholders see future potential growth and in future cash flows, which is a good thing. So lastly, we're going to move into EVA and competitors. This is kind of where Exxon shines. As you see, their EVA is far beyond that of all their competitors. Far ahead, excuse me. And they're also leading in terms of return on investment capital and market cap. And the last thing, BP has the highest earnings per share, which is a good thing that they're making money for shareholders, especially considering some of the previous incidents that they've had. This leads me to my final choice on motors, which is Exxon. I like what Exxon's doing. They have the least leverage with the highest cash coverage. They're delegating assets and operating very efficiently, going above and beyond expectations in terms of returns, in terms of efficiency and performance. And they're in very high regard with shareholders, and they're earning high returns on shareholder money. So I believe that they are in the best position, and that's the company I like. So that was my analysis. Again, I'm Russell Pellequino. Thank you for watching.